Friends, everyone, welcome. Today it is April 6, 2022, and what a wild ride it's been over the last few days on the Treasury market. I actually did a video last week talking about some things, and what my goal is with these videos is to talk about world events, current events here in the United States, and how it relates to your specific situation with housing. Because American housing is not left unaffected by world events and things going on around the world. So what you're looking at right now is the U.S. 10-year Treasury. This is actually, it closed down, it closed last week below 2.5, is like 2.48 or something like that. Earlier today, it was actually trading at about 2.64. So it's actually come down. Last week I said it's going to be to expect some volatility within the Treasury markets. I still see that moving forward. And why this is important, friends, everyone, because the 10-year Treasury is what affects mortgage rates and lending rates, as that's what this goes off of. And so the dreaded R word, the recession word, has been thrown around, which is kind of also why I want to do this video. What people are saying is that there's an inversion going on, and it is flirting with an inversion. The 2-year was actually trading lower than the 10-year for a while, and that's what it means. The 10-year should always be trading higher than the 2-year because that's the window for margins and trade rates. And so we did see a little bit of an inversion going on last week. We did see one in 2019 too, before the COVID thing happened, and we did hit a recession. Can you blame it on an inversion or COVID? I'm not so sure. But most of the time, when there is an inversion, it's just a signal. It's one of a few handful of signals that happen. Yes, most of the time when there is an inversion, but it depends upon how deep that is. And so in 2019, it wasn't that much. It wasn't that deep. So it's just it's a cautionary flag. Keep an eye on this. But as I said, I expect some volatility. But remember this, and I'm going to echo this until this doesn't matter anymore, or I see things differently. There is no way in heck that the Federal Reserve can raise rates high enough. Okay, they can't raise them high enough to fight inflation, true inflationary pressures. So this is, in my opinion, very bullish for the housing market. And the things I may say along the way, I'm not completely bearish on it, meaning I wouldn't shy away from real estate. But at the same time, there are certain things to watch out for. And so this is one of them. If the U.S. 10-year Treasury starts to climb towards 3%, we're going to get into an area where interest rates are going to, in my opinion, have a direct impact on housing prices. You are going to see, and you are right now, other people in the industries, whether they remortgage industries or real estate, they're out there. Oh, go buy houses. Go buy houses right now before rates go up too high, and all of this stuff. And you'll never hear me say that. You'll never hear me say go out and buy anything, because there are way too many things to look at outside of just the 10-year Treasury and how it's affecting the mortgage markets. Okay, there's way too much. Geopolitical stance. If Russia and China and those countries and the BRICS nations continue to trade outside of the dollar, and the Federal Reserve note, the American dollar, loses reserve currency around the world, guess what's going to happen? Guess what's going to happen to the value of the dollar? Now, let me ask you this question: will that lead to more inflation or less inflation? And here's a hint: no one can answer that, because, as I've said in other videos, this is all theoretical. Our whole economy is theoretical. We've never been here before. No one knows. Well, the Fed, the top of the people running the thing, know. But in terms of anybody else, the pundits on TV, the news, the propagandists, they have no idea. So my purpose of these videos is to give a different synopsis, if you will, of the situation versus what other people are parroting. And I can't stand to see it, because they couldn't answer. Okay, I'll give you 3 questions to ask people. 1, to what extent does the Federal Reserve own mortgage-backed securities? How much of their ledger on their books is mortgage-backed securities, and why does that matter? 2, to what extent does companies like BlackRock and Vanguard own real estate? Now, these are companies that have trillions of dollars under management. Of those trillions of dollars, how much is invested into real estate, and why does that matter? 3rd, the derivative market that caused the meltdown in 2008 and 9. And did that go away? And if you believe it went away, how did it go away, and can you prove it? So I would ask those three questions to the people that you hear out in the marketplace and out and about spouting all of this stuff, because all they're doing, you guys, fear is the number one motivator in anything. Fear is, everyone in marketing and advertising knows that fear, and it could be good fear and it could be bad fear. But think about this. You have people out there going, go out and buy real estate, go out and buy real estate before rates rise. Well, it's a fear. It's a fear tactic. How do you know rates are going to rise? I am by no means 100% correct 100% of the time, but I will rest on two things. One, when the Fed came out and said in 2009 that we're going to try one round of quantitative easing, which is at the end of the day just extreme money printing, and we're going to hand out all of this free money, helicopter money. I said something. I said there is no way that they're going to do just one round. This is going to be quantitative easing ad infinitum, ad nauseum, and that's exactly what's happened because they're still doing it. Okay. Also, a year and a half ago, up until a year and a half ago, people have been saying, well, they're going to raise rates. They need to raise rates to make our money more attractive and to stop inflationary pressures along the way and all this stuff. I said, they're not worried about inflation because that's the goal. That's the goal of what they're doing, is to inflate everything because they want to own everything. That's my opinion. So they're going to inflate it, buy back the mortgage-backed securities, and own that asset. No matter what happens to the value of the dollar, they, at the end of the day, are going to own it. And so, no, they're not going to raise rates. Well, guess what's happened over the last 10, 12 years? Interest rates have gone down. I will say this, that in the beginning, I did believe that they were going to have to raise rates to fight inflation, but in somewhere around 2012-ish, I changed my tune because I realized I realized my opinion of it and what the game I think is going on. And the third thing is that when inflation started to hit a couple years ago, I said it's not transitory. This is not a transitory thing because inflation simply is the introduction of fiat currency into the marketplace. So they've been inflating. Now, the result of that is what they're talking about, saying that they're transitory. No, they're not transitory, and I said that in the beginning. So how does this all relate to you in housing market and whether or not to buy? I mean, that's the question, is it not? And I think it's a great question, so I want to answer it real quick here. There is no way that the Federal Reserve can control every aspect outside of inflation. And if they do try to control inflation by raising rates, they're absolutely going to cripple the economy. And to what extent, and I did a video on this earlier showing the parabolic move in 2006 and 7 in terms of interest rates going down and inflation going high. The parabolic move is actually higher. So I'm going to leave you with this. And I'll do other smaller videos about things that I could go off on here. But in terms of investment, if I were a speculator right now, thinking that I'm going to put my money into real estate, believing that it's going to appreciate 15% next year and another 10% after that and 12% after that, no, I would not, as a speculator, be moving into real estate right now. Now, as a long-term holder of real estate, yes, because real estate it always recovered. Real estate isn't less than what it was in 1937 or 1948. You know what I'm saying? Relative to inflation, it's still beating the real value of the dollar. So long term, if I don't care about rate of return, yeah, I'm going to invest in real estate. However, as a speculator, I would never do it. Now, saying that, if I am looking for peace of mind, I'm in an apartment, I'm sick and tired of people above me pounding and kids running down the hallways and dogs barking and this and that, yeah, you can't put a price on those things. Not to mention the fact that, and those people looking at rentals right now and those people already renting are seeing rental rate increases, right? It's happening pretty much across the board. So I can go buy a house right now, at a 2,000 square foot house right now, at or less than what I could rent it for, which is not different. It's no different than what's been happening in the last 10, 12 years. And so if you're thinking long term, I just want peace of mind. I want my own place. I don't care necessarily what rates are at right now, just as long as I can get into that at the same price than what I can rent for. Why wouldn't you? So that's the value benefit of it, you know. And thinking long term, I'm going to be in this place 5, 7, 8 years anyway. So what difference does it make to me? I'm not throwing away money on rent. That's the mindset to have. And that is why I'm saying right now, folks, that this 10-year treasury isn't at a position where it's affecting rates to the point where you have to worry about renting versus buying. It's still a great time to buy. And in my opinion, and this is why I'm bearish of all the things that I've said and could say and things that could be taken negatively. And I know I'm getting past 10 minutes here, so I'm going to wrap it up. But I am not bearish on housing at all right now. I'm bullish on it for so many reasons that you can't put a price tag on, like peace and quiet and your own living space and all of that, all of those things. So again, I wouldn't fear rates rising. I wouldn't make that a reason to buy. I don't think that they can go high enough to fight off those inflationary pressures. We'll see. We'll see. I may change my tune in terms of new data that comes in, but right now I'm not. So anyway, until next time, friends, go out and make it a great day. Create that day for you that you want. That's the point of all of this. So till next time, take care. Bye.